Hi everyone, this is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a registered investment advisor representative for SitkaPacific Capital Management. He has one of the top global economics blogs in the world. And from an Austrian school perspective, Mish Shedlock, thank you for joining me again.
Oh, pleasure to be back on the show, Jason.
Now, Mish, I want to ask you about the Federal Reserve here. There's so many Federal Reserve Board of Governors jumping ship. I think there's four open seats now with Stanley Fischer handing in his resignation letter yesterday. Do you think the Federal Reserve will raise interest rates again in 2017? And do you think this correlates maybe with what they're planning on doing with their balance sheet?
I just wrote about this just a few minutes ago. I didn't think they'd get more than 2 hikes in. They got 4 in. But sticking with my current call, I think we're done. I think the next move is actually going to be a cut. The global economy is slowing, although it's, some people would dispute that. But the effect of 2 hurricanes now in the U.S. Is going to weigh on the Fed's mind. The Treasury yields today plunging. So the market doesn't see a rate hike in December. I don't either. A couple months back, the odds of a December hike were over 70% or near 70%. Now they're down to about 1 in 3, and I think done actually.
I agree with you about the global economy. I don't see a lot of signs that it's doing well, but the copper price has had a big rally. I don't think that's driven by, global economic growth. I think it's for other factors, either like a short squeeze, or maybe there's a counterparty in China that needs the collateral. They had to empty the warehouse, and there's some type of short squeeze, or there was some type of manipulation in the commodities markets. So I think that's why the copper price rose. I don't think it's because the global economy is, doing very well.
That'd be pretty much my assessment on copper. Something in China could do that. Speculation, actually, and everything is just pretty much running rampant. It's nice to see gold getting a bid here now. I look at some of the charts of the miners, and they're on the verge of breaking out. We've seen this play before, and only to have the miners head back down. This looks like the real deal to me, and obviously the best time to buy some of these miners was about a year ago, January. These companies were share prices were priced as if they were going to go out of business. We've seen 10 baggers in some of the miners. I was in several of them. I wish I had more.
So you think gold then has bottomed? Do you think maybe then if it sells off a little bit, those dips are being bought now as compared to the recent past?
Yeah, clearly there's been a trend change here. It's hard to understand why. Personally, I believe gold follows belief in central banks, whether or not they have everything under control. Just posted a chart on this on my blog as well. I got an interesting email today from Steen Jacobsen, the chief economist and CIO for Saxo Bank in Copenhagen. And he's predicting 10-year Treasury yields are going to go to 10%. He's pulled out of equities except for gold. And I posted a chart in that article, and it shows gold versus sentiment and not versus inflation, but gold versus faith in central banks. Faith in central banks was in question in 1980. Volcker and Greenspan brought that under control. The price of gold fell from $850 all the way down to $250. Then we had a dot-com bubble brewing and a housing bubble brewing on top of that. Gold reacted favorably to both of those things. Then gold hit 1900, and Europe was a complete disaster case. Mario Draghi came out with his famous speech, "We will do whatever it takes to save the euro, and believe me, it will be enough." And within a short time after that, yields of European sovereign bonds crashed. Gold crashed along with it. I think what we're seeing now is renewed concern that maybe, just maybe, central banks don't have everything under control. And of course, there's a lot of concern about Trump not being in control, North Korea not being in control. There's all of these uncertainties are giving a little bit of a boost to gold. I don't see these uncertainties, certainly at least in regards to the Fed, is going away anytime soon.
And to add to your points there about the European Central Bank, you know, the whatever it takes speech was a little over 5 years ago, but the European Central Bank balance sheet is now larger than the Federal Reserve balance sheet, and so is the Bank of Japan's balance sheet. Mm-hmm. Are you surprised that, you know, we're living in a world now where the central banks, whether it's the Federal Reserve, the Bank of Japan, the Bank of England, the European Central Bank, we don't know what the real numbers are for the People's Bank of China. Are you surprised that they can create literally over 18 trillion money in credit out of thin air and just buy up asset purchases, and it really doesn't cause that many problems in the real world?
Well, it's caused a lot of problems. We just haven't seen them yet. They've blown another bubble, and that's just it. They're doing this because they're worried about deflation. Well, they're worried about the wrong kind of deflation. They're worried about prices falling. The BIS, the Bank of International Settlements, has done numerous studies and reports on this, and they've determined that routine deflation is actually a benefit. But central banks don't believe that, so they've flooded the world with all this liquidity. It'll find a home. It didn't go where the central banks wanted it to. It didn't go into wages. Wages growth has been pretty anemic. It didn't go into the prices of electronics or prices of most consumer goods. Instead, we've blown another asset bubble. And when asset bubbles pop, they're going to bring about the real deflation, which is asset deflation, which is what central banks ought to be worried about. I've written about this a number of times over the years. I keep hammering this point home. Central banks are the source here of this next crisis.
Exactly, and they're creating an illusion of stability now. So, you know, Minsky, when he wrote the financial instability hypothesis, he said central banks create stability. I would argue that they create an illusion of stability, not real long-term stability, and, you know, they're going to create money and credit bubbles. You brought up deflation, though. You know, I know you follow the Austrian School of Economics, so do I. There is such things as beneficial deflation, but go and try and tell that to a lot of Keynesian economists, even though, you know, in the real world, people want, you know, cheaper, higher quality flat screen TVs or digital cameras or smartphones or, you know, better laptops. People see these in the real world. They don't equate this to the gobbledygook that is Keynesian economics that is always fighting deflation.
Standards of living rise when prices fall. That's just a simple statement of fact. And if you would just stop and think about that for a second, let's assume the price of a car fell to, I don't know, fell all the way down to $1,000 or something. More people would be able to afford them, not just here, but globally. When products first come out, new products first come out, they tend to be really high. No one can afford the things. Just think back about 20 years. You had windows. You had these dual pane gas-filled, argon-filled windows to reduce UV radiation coming. No one could afford those things. Now that such windows are commonplace. The prices of various technology. Look at a cell phone. It was enormous when it first came out. No one could afford them. Now everyone has one. Computers are getting more and more powerful and more affordable all of the time. Yet the central banks are fighting these trends. And they're deflationary trends, and I get into it. People on my blog all the time, you know, claiming, China's stealing all of our jobs. Yada yada. The problem is not that people don't have enough money, but rather the money they have doesn't go far enough, thanks to the inflationist policies of the Fed and central governments wanting higher prices. That is the root cause of these problems, and people are trying to attack symptoms with these things like living wages and $15 minimum, wages at McDonald's. Most of these people are not worth $15 an hour, period.
Yeah, I would agree that they're not allowing the central planners, whether they're bureaucrats or central bankers or politicians, they don't want to allow wages and prices to fall, and that would benefit a lot more people than they would expect. In the short term, it would probably get politicians fired, it would get central bankers, yelled at, but that would be good long term for a lot of people in the middle class and the poor people who then there would be more incentives for them to go out and save money and maybe increase their standard of living. The other thing is, people who are blaming China for jobs. The problem is here in the United States, Mish, there's just too many taxes, rules, and regulations if you want to start a new business other than like an online business. So for many industries, like whether it's a food truck or so many other things, there's so many hoops that you have to jump through for permits and rules and regulations and business insurance that like the entrepreneurship for past generations is so much more difficult unless you're just building an online business now.
Well, manufacturing is returning to the U.S. It's returning actually locally everywhere, from China, from North Korea, from Indonesia, and it's just returning without jobs. There's a Sobot factory going up. I think it was Oklahoma. I wrote about it on my blog. They're going to produce 24 million T-shirts a year at a cost of 33 cents a piece. It's to produce 24 million T-shirts is going to create a grand total of 400 jobs because it's all automated. So, and the higher we have, the higher we push minimum wages, and the lower the Fed holds interest rates, the greater the incentive and opportunity for companies to go out and either speculate in their own stock with stock buybacks or buy equipment whose main purpose is to get rid of workers. That's what these cheap interest rates have done. It's all going to backfire here. I don't know when. I would have thought this would have happened by now, 2 years ago actually. But it's going to happen. I think the stock market's in for something like a 50% decline over a sustained period of time. That's how big the Fed has blown this bubble, central banks in general.
And to add to your points there, if President Trump does start a trade war with China, maybe with tariffs on imported Chinese goods, and then China retaliates, I think the real winners in a trade war with China are going to be even more so than now. This was already a trend, as you've been covering for years on your blog with the articles about robotics and automation and how those factory workers are being replaced even in China. Foxconn is moving a plant here to Wisconsin. There is going to be some humans there, but not nearly as many. It's going to be mostly robots and automation, in addition to the subsidies the state of Wisconsin is giving them. But I think the real winner in a trade war with China is going to be an increase in robotics and automation. So people are telling me, Trump should, put all these tariffs on Chinese goods and they've destroyed our jobs and Trump will bring the jobs back. Well, he may bring back some jobs and there's going to be capital investment maybe back in the U.S., but it's not going to create nearly as many. You're not going to have the old factories where there's 5,000 or more human workers at the factory. It's going to be, like you said, 100 to 100 or less maybe humans, and it's going to be almost all automated. So the real winners are going to be further acceleration of that robotics and automation trend.
Well, it'll bring the manufacturing back, not the jobs. But the first thing tariffs will do is cause a collapse in trade, and that won't be good for anyone. China is likely to retaliate. Perhaps they hold rare earth metals or something that we need for our defense industry. Most of those things come from China. There's a number of things China can do. Russia could hold refined uranium. There's plenty of uranium in the world, but there's not plenty of refined uranium in the world. Most of that comes from Russia. So if we start a major trade war with Russia with more sanctions, and Russia decides to retaliate by holding off refined uranium. Well, we don't have uranium now for our power plants, those that do use it. So there are really no winners in these trade wars because of the retaliations. We got any number of things here now: a trade war, a real war with North Korea, the EU getting into a major trade war with the UK. Any of these things can kick off a global recession. One of them is going to.
The other one that I don't think a lot of people are talking about, really only hedge fund managers are talking about this, is China. Do you think China will do an enormous bailout of their state-owned banks because of non-performing loans?
I think it's probably going on the sly here right now. There's still a lot of capital flight from China. Bitcoin is actually one of the means of capital flight. And China has hinted at cracking down on that. It has stopped these ICOs, these initial coin offerings. But one of the ways that people have gotten their money out of China is to buy Bitcoin with it, go to a casino in Hong Kong, exchange that back for cash. We've seen real estate bubbles in both the west coast of the U.S. and in Canada, in Vancouver and Toronto, all from capital flight from China. The central banks have so distorted everything with all of their currency manipulation, interest rate manipulation, currency manipulation in China, interest rate manipulation in the U.S., and asset QE manipulation in the U.S., the EU, and Japan, that there's no real price discovery. These guys have no idea what the price of anything should be. If central banks were to announce tomorrow that they were going to set the price of orange juice, everyone would stand up and say, what? That's impossible. That doesn't happen. Yet it's probably inherently much more difficult to set the price of money than it would be to set the price of orange juice.
Yeah, as an Austrian economist, I just see trillions in misallocated capital in China. I see it in the United States. I see it from Japan. And, so far, we've had the global financial crisis in 2008. People are acting, a lot of people have a very short-term memory now. They're acting as if it never happened. Look at the real estate prices, as you mentioned, whether it's Chinese flight capital that's moved into those housing markets. In some cities, Mish, it's like the 2008 housing crisis never even happened. The property values are even higher than they were before the 2008 financial crisis.
That actually surprised me. Typically you don't reblow the last bubble right away, but we did. But this was an everything bubble, so think of the tech crash. Some of those technology companies did not recover for years. Some of them, Global Crossing comes to mind, and some other ones, went out of business and never recovered at all. Cisco, never reblow the what it was worth in 2000, 20 years ago. But here, so we had this housing bubble and a housing crash, and the Fed's managed to reblow the housing bubble. Quite amazing, actually. It's morphed into what is commonly called, I didn't come up with the term, the everything bubble. Now, it's not quite everything. You can still find a handful of value here and there. I believe gold and miners are of value here, but there's not much. And if you look back to the tech crash in 2000, the average PE was higher than it is now, but the median PE was much lower back then. There were real value plays back in 2000 for those not chasing the tech wreck. There was value in energy companies. That's the main sector. There was value in gold companies. There was probably value in retailers. A lot of companies were trading really cheap, but the technology skewed it so much that the average PE was through the roof. Well, now everything is through the roof. The median PEs are at or close to an all-time high, exceeding what we saw in 2000, in 2007, and 1929.
Yeah, I interviewed Dr. Chris Martenson last week, and he brought up the term everything bubble. Are you shorting anything now, or do you think this is a dangerous environment to be shorting things?
I've not shorted. Occasionally, I've bought a round of puts with mixed success. Certainly, if you were quick, there were some profits to be made, but pretty much I just stopped. I just rather play things that are in a gold market or bull market here. And I think gold is back in a bull market, and that's where my focus has been. There's some small biotech companies that I like that have real products. They're thinly traded, so I won't mention them. But I got into a private placement in one, so it wouldn't even do people any good if I did mention it. But there's pockets of value out there, but they're really tiny, and they're mainly in small caps. It's not something the average mutual fund could own, because some of these things are pretty illiquid.
Yeah, and President Trump has actually, he's brought in a more free market head of the FDA. So I think there's going to be more opportunity there for small biotechnology companies. They're going to have a lot more tailwinds now, as opposed to the past where there were more hoops from the FDA to jump through. As a former resident of Illinois, I want to ask you your opinion. We've talked about the housing prices that have gone back up, but the state of Illinois is still in the hole financially. And, their politicians and bureaucrats there think that, they can solve all their problems by just trying to raise taxes very quickly on residents by 33%, and people won't deal with it. What was your reaction when you heard that the politicians in Illinois earlier in the year wanted to, with their budget deficit, just raise taxes 33% on state residents?
Yeah, it was totally expected. First off, I did not make my great escape yet. It's still planned, but hardly surprising at all. Very, very disappointing. Actually, the talks were on the verge of collapse. Someone from Ronner's team actually managed to pull these things together. And then Ronner himself demanded the legislatures get back and do something. He should have just let them walk away. We still wouldn't have a budget. Instead, now they're raising taxes on everything. More taxes coming in Chicago. People are escaping Illinois. It's one of the few states actually losing population. So our problems are not solved, and most of this money that they raise goes straight into pensions, and Illinois pension plans are woefully underfunded, something like 40% on average. And it doesn't even take a stock market crash to sink Illinois pension plans. Some of these things will run out of money if stocks just simply go flat for the next 4 or 5 years. And flat is certainly not what I'm expecting here. So even a modest decline of 2 or 3% a year for a few years will crucify Illinois pension plans, and something like a 20 or 30% decline, that then goes nowhere for a few years, Illinois pension plans will almost immediately be insolvent should such a thing happen, and that's my prediction.
It's extremely frustrating to see, politicians and bureaucrats try to solve a problem by just raising taxes. So there's plenty of historical evidence that this is not going to solve their problems, and yet they repeatedly do it. I guess, the saying about history is if you don't learn from the past, you're doomed to repeat it. But I think one of the main lessons of history is that people don't learn from history. But Meredith Whitney predicted this pension fund crisis. I think she was 6 years early. So, she got roasted when she was going on all the mainstream financial media shows 2010 and 11 talking about this. But, now we're starting to see big cracks pretty much all over the United States.
Well, what she predicted actually was not a pension crisis, but what she predicted was a municipal bond crash, which did not happen. Certainly, we've seen municipal bonds in Chicago and Illinois get clobbered, but downgraded to junk status, and it's just a matter of time, in my opinion, before some of these things default. So one probably could have actually found some high grade munis and some safer states and done quite well with them, but Illinois is not one of the places where you would want to be in munis.
Yeah, I agree. A lot of those states like New York, New Jersey, Illinois, California, those Detroit, the Michigan state of Michigan, those states seem to be in trouble the most. Although there was, I think, a run last year in 2016 on a Dallas pension plan. Either it was last year or earlier in the year. I want to ask you my last question for the interview. Big picture question about President Trump. I know you're a libertarian. You like the Austrian School of Economics. Has he done anything you like so far?
That's a good question. I'm sure he's done something. He's not done anything major that I like. He's mishandled about everything. The war in Afghanistan, I disagree with. I disagree with his tariff policy. Troops. He talked about cooperating with Russia. Didn't do that. Some of that's not his own fault, but it didn't get done. He did not handle Obamacare very smartly, and he would have been wise to go after tax policy first. Now his presidency is crippled. Actually, I came up with one while rambling here on this. I like his appointee to the Supreme Court. And we'll see. I'm waiting for some rulings later on this year that reins in public pensions. I think he made a good choice for that Supreme Court justice, and he's going to get to pick some more judges. That might be one of the key things he gets to do in his administration and do well, is actually pick justices.
Yeah, I agree. That's one of the few things that he picked a pro-Constitution U.S. Supreme Court justice. But, I think one of the main problems, Mish, is that he surrounded himself, like the 8 main people that are advising him. You have 3 former Goldman Sachs guys that are hardcore Democrat. They're basically globalist. So those are his main economics advisors, whether it's Gary Cohn, Steve Mnuchin, and I forgot the third Goldman Sachs person right offhand. Maybe it was Bannon. There might be one more. You have 3 Marine neocon generals who are basically warmongers. They have a history of not only wanting to fight wars but also losing them. I think McMaster, who's fired a lot of the pro-Trump people in his administration and his advisors. McMaster actually wrote a book about how LBJ could have won Vietnam had he not pulled out the troops and increased the troops. So, that's worrisome. And then Ivanka and her husband Jared Kushner, I don't think they're independents like Trump is, because Trump just basically used the Republican ticket as an independent. I don't think he was a real Republican or conservative. I think Jared Kushner and Ivanka Trump are essentially just rich Democrats, globalists. So those are the main people he's taking advice from. And I think, you combine that with his personality and all the crazy things he does on Twitter, and that's why you have this media. The mainstream media is also lying, but it's just crazy what's been going on, the war between him and the mainstream media.
Absolutely, his administration has been essentially crippled. We'll see if he gets any kind of tax, corporate tax package through. I think slashing corporate taxes would be a good thing to do. Let's see if he gets that done. But right now, I don't have hopes of much anything. And, he's playing around with some fire in some really serious areas here with North Korea, a trade war with China. So very disappointing, I guess, other than a Supreme Court pick would be how I would sum up the administration's effort so far.
He also has 4 empty seats for the Federal Reserve Board of Governors because, all these hardcore Keynesians are all jumping ship before the stock markets and other markets crash before the next global financial crisis. I'd like to see him put in some Austrian school free market people, maybe some people that would support some type of gold standard. But I don't know if he's going to be able to. Number one, I'm not sure if he would nominate them, and number two, even if he did nominate them, I'm not sure if they would get through the Senate for confirmation.
I think his nominee would get through, whether or not he's got any picks like that. I mean, his top pick was supposedly this guy from Goldman Sachs, so that's not encouraging. Now, apparently, this guy's taken himself out of the picture by criticizing Trump. So I don't know who we're going to end up with. It's possible Yellen's a repeat. I seriously doubt it, actually. Trump's going to want his own person in there. But if his own person is what Trump probably wants now, I don't know. It's hard to say what's on this guy's mind because it changes. His message changes all the time. But if he wants someone who's in favor of a weaker dollar, well, that's the kind of person they're going to put in at the Fed.
I think Janet Yellen, or her term expires in February 2018. I think she'll want to be gone in February or March, early next year. Why would she stick around and risk taking the blame at the Federal Reserve when she can, either go back to academia and earn a fourth or fifth pension, a defined benefit pension, or do what Alan Greenspan and Bernanke have with these high speaking fees, or go and consult for a hedge fund, or write a book about how Trump made her do things she didn't want to do with the economic policy. So write a book bashing Trump.
Yeah, that's pretty much where we're headed right now. We're just kind of in lockdown mode here. A number of things on Trump policy, on hurricanes, on trade policy, and just waiting here for the market to turn. I think it's going to, and it's going to go a lot deeper than most expect.
Do you think the dollar index will crash, or do you think then that we're just going to have a lot of volatility in the dollar index? Because early in our conversation, we were talking about how all these other central banks are either coordinating with each other, if they're large central banks like the Bank of Japan, the ECB, the Fed, taking turns either raising interest rates or devaluing their currency with exchange rates. So do you expect then the dollar range to be volatile, but like stay in a trading range rather than crash?
I don't expect a crash for the simple reason there's too many problems with the euro. So if the euro has peaked, that's going to perhaps halt a dollar slide for a while. We're still not out of the woods. In Europe, Italy, well, the Italian banking system is insolvent. Actually, the entire European banking system is completely insolvent. So any kind of renewed crisis, that's another area where something can go seriously wrong in a hurry. Is with the European banking system. So those would tend to be dollar favorable here. So we've got a lot of cross currents. The Fed not hiking is a measure for weakening the dollar, but on the other hand, if there's a crisis in euro and Mario Draghi picks back up his bond purchases, we can see the euro sink. So I don't think that there's going to be any quick crash or any quick move one way or another unless we see a crisis in the euro, and that's quite possible.
Yeah, I see lots of economic landmines all over the global economy and in asset markets. So I'm not really sure that the dollar will be the only currency that's going to fall. I think all these central bankers are basically Keynesian. Even the ones in China are hardcore Keynesian, although China's buying, a lot of physical gold. So I see, no one wants a strong currency. So I'm not really sure like what I think Peter Schiff's a smart guy, but, he's been saying for years that the dollar is going to collapse and he wants to be in other currencies. I'm not sure I really see that, though.
I would disagree with him on that. Right now, the trend in the dollar is clearly down, but I don't think it's going to crash, and it could rise considerably again if there's a crisis in Euroland.
Well, Mish, I always enjoy talking to you, and I think your wealth of information, you cover so many different topics. You actually were one of the first economics bloggers to be talking about robotics and automation, 6 or 7 years ago. So I congratulate you on that because, we're starting to see that trend. I think a lot of people thought, in China they wouldn't really automate as quickly as they have, but wages have grown, I think, over 500% in China in the last decade. So even China now is starting to fire a lot of their human factory workers. But if our listeners want to follow more of your work at MikshTalk, how do they do so?
MikshTalk.com. I write a couple times a day. I've also got a photography website out there. Please check that out as well. MishMoments.com, M-O-M-E-N-T-S, MikshTalk and Mish Moments. I write about the economy and about 4 times a day. And about once a week, I post an interesting article on photography, where I was, how I took the shot, etc. So check that out as well.
Very cool. Well, I enjoy your insights and keep up the great work.
Thanks.
Wall Street for Main Street needs your help. Since the middle of 2016, YouTube continues to increasingly censor and sabotage the growth and success of my channel with dramatically slower or no subscriber growth, a huge decrease in views per month compared to 2016, and well over $10,000 lost in Google AdSense revenues the last 18 months. I should have been way over 20,000 subscribers and way over 3 million views last year, but it feels like I am Sisyphus trying to roll a heavier boulder with more and more additional weight up a steeper and steeper hill. In the last few weeks, all of my videos have been set to demonetization by default, and I have to manually protest each video. This is in addition to even lower than usual Google AdSense revenues after the adpocalypse started over a year ago for me. This has also affected my ability to get paid advertisers to agree to deals not involving YouTube, as I lost $3,000 per month in paid advertising deals at the end of June 2017 because all my analytics are down a lot thanks to YouTube censorship algorithms that have intentionally kneecapped the growth of my channel. With YouTube/Google/Alphabet /Don't Be Evil strongly considering demonetizing or setting all libertarian, conservative, or pro-Trump content to private to prevent any sharing or monetization, it is imperative I have a contingency plan to figure out how to make a living off my content. Each 30 to 40 minute video takes a few hours of my time before it's released to the public. There's a strong possibility that in the near future, YouTube will force me to move all or almost all my content to a new video upload website that allows free speech or behind a paywall on my own website. Thanks if you have already made a one-time or recurring monthly donation, and thanks in advance for any future donations as I decide the future of my channel and what to do with my content going forward. We accept one-time donations on the Wall Street for Main Street website via PayPal, Bitcoin, or Gold Money. You can also become a monthly Patreon contributor for $1 or more a month if you want to help me out. And don't forget to like each video on YouTube and share it with your friends and family if you think they would like the content.